In this video, traders, we're going to look at what is a trading limit and should you use one. Stay tuned. Hey guys, warm welcome to you. Alright, so you've probably all heard of a trailing stop, right? Trailing stop, literally just as the price starts to move up in your direction, the stop will move up in your direction to lock in gains as it goes, As the price moves down, in the case of a sell stop, as the price starts to move down, then the price won't ratchet lower, it will stay where it is, and so it locks in gains. So as the price extends, pushes up, comes back, tags it. We all know that's it, that's all about. Many of you guys will use it as part of your trading strategy. It makes perfect sense to lock in gains. Right? What about a trailing limit? Now, a trailing limit isn't often native to a lot of spread betting platforms, CFD platforms, spot FX platforms. It is available on some of the kind of more complicated or more institutional grade exchange platforms, ones that trade directly to the exchange. However, the point is, can we replicate it? Do we even want to use it? And what's the whole point of it? So a trading limit is pretty much this, guys. If we've got a situation where market's going up, okay, and we want to buy a pullback, so we don't want to buy now, we don't want to buy at a specific level. We want to buy, let's say, a 50% retracement of the move. And so what we would do is we would place a limit order, a trailing limit order that says, hey, I want to trail the market by whatever we are. So let's say we've moved up, let's say we're 100 ticks up. So we want to say, okay, I want 50 ticks off the high. So we'd have a trading limit here, 50 ticks. And what that would do, actually, you couldn't do a 50% retracement, could you? Because you have to have it offset by a certain number of ticks or a percentage. And as that extends, that'll be slightly different. What you could do is offset based on the actual absolute value. So in ticks or cents or percentage or whatever it may be. So let's go back to that point. So let's say, okay, I want to buy a 50 tick retracement off the high. Then literally as this starts to push up and up and up, the limit order will move up just like a trailing stop does, and it will just ratchet up. So as the price moves lower, of course, it won't move because you're getting closer to being filled. So what that's doing is basically saying, hey, I want to buy, but I want to buy a pullback, a certain pullback as the market goes up. Then as the market comes down, if it runs through your level, you're going to be filled at that level, and hopefully it's going to push up. And the thesis of the trade in this example would be, hey, I'm buying a pullback of X. Now that's very nice if we're talking about aligning with the rotational size of the market, something I've done a video on before. Very important topic, guys, for day traders. Rotation and measuring in the market. Hey, well, the S&P 500 is rotating in kind of 2-point increments. The Dow's rotating in 20 points, i.e. it's going up 30, back 20, up 30, back 20, 25. It's around that level. That way you can use that trading limit and say, well, these are the average rotations back in this trend. We're getting average points of, in this case, 50 tick pullbacks. Okay, well, I will use a trading limit. I don't know how high the initial pulse is going to be, but I know that on average, the expected rotation, the expected counter trend move is 50 ticks. So I'm going to use that trading limit. So it's a really good strategy in a way of getting in, if that's your methodology. Like, listen, I want to have a hypothesis that we're going to hit a price level up here. I don't want to chase it. I want to buy a pullback. However, I don't want to have a defined level, because if we push on and on and on, then it's going to be way below the level I want to buy at. I want to have it at an absolute level off the high. Then this trading limit works, and it works very nicely. Now, if you were to replicate that in a platform that doesn't have it, it's going to be tricky. I'm going to be honest with you, it's going to be tricky. You're going to have to ratchet it up. And what you could do, I guess you could do, is set, depending on how your time frame you're trading, set alerts for specific times of the day, like every hour or something, see where the price has gone, and then move it up. Is it going to be as good as an automatic limit order that ratchets up with the price? No, it's not. But what you're going to do is, as the price moves, you're going to have to be able to block it up in chunks and move it up in chunks and move it up to the last high. And so theoretically, unless it reversed fully in that hour, then you're not going to miss out, because if it moves up in an hour, and even if it moves down, you still put the limit based on the price high. So if we kind of log in at this time, for example, you'd still be setting it based on that high, so you'd still be placing it there. So unless it did the full retracement in the hour and didn't fill you, you'd probably be okay. For example, you could obviously split that up as much as you wanted. So that's not a bad strategy. For you swing traders, it's going to be perfectly fine, isn't it? Because you're going to trade at the end of the day. You're going to probably look at the end of the day and start to move the limits and adjust them and adjust all your orders and portfolio, etc. at the end of the day or beginning of the day or wherever you normally do it. So you can normally get away with that kind of thing. Anyway, I think it's a great little idea. I think it's really useful useful, especially when you're thinking in terms of, hey, I don't want to chase stuff. I just want to make sure that I'm getting on the retracement, I'm buying on red, I'm buying on the counter trend move, I'm in sync with the market, in tune with the market. I think this is a nice way of approaching it. And if you can't do it natively with your platform, then try and do it. You kind of make your own way of doing it up so that you're not chasing the market, so that you are still involved when the market pulls back to the level that you exactly want to buy at. All right, guys, that is the trailing limit. Should you use it? See you next one, guys. Take care. Bye-bye.